So you keep seeing all these people tell you, man, buy the dip, invest in the stock market, buy this and buy that, and you're not sure if you should, if it's a good idea or not, right? Let's talk about that. Is it a good idea? What are some of the benefits? What are some of the disadvantages of investing in the stock market and stocks and all those things, right? All right, well, let's start off with the benefits, right? Let's start off with the good stuff. So let's talk about some benefits. So one of them is takes advantage of a growing economy because as the economy grows, businesses make more money, right? And that's because economic growth creates jobs, which makes income, which makes sales, right? And the bigger the paycheck, the greater the boost to the consumer demand, which drives more money into companies, right? Right? Of course, it helps to understand the phases of businesses, right? You've got expansion, peak, contraction, and trough, right? So another way is it's a really good way to stay ahead of inflation. Historically, stocks have averaged an annualized return of about 10%. Now, that's better than the average annualized inflation rate, right? But it does mean you got to have a longer time horizon. That way, you can buy and hold even if the value, temporarily goes down, right? Another great thing is that stocks are easy to buy. The stock market makes it easy to buy shares of any company, right? You can purchase them through a broker or a financial planner, or even online, right? You can set up an account, and then you got accounts like, or companies like Robinhood and M1 and stuff. You can buy and sell stocks commission free, right? Now, the fourth way is that you can make money in two different ways. A lot of investors, they want to buy low, sell high, right? They invest in fast growing companies that appreciate in value, right? Now that's attractive to both day traders and buy and hold investors. Now with day traders, they're going to hope to take advantage of short term trends, right? While your buy and hold investors like me, right, we expect to see the company's earnings and stock price grow over time. Now, they both believe their stock picking skills allow them to outperform the market. Other investors prefer a regular stream of cash, right? They purchase stocks of companies that pay dividends, and then those companies, they grow at a moderate rate, right? Because since they're paying out that dividend, they don't have as much money for expansion and growth, okay? One of the last benefits we're going to talk about is how easy it is to sell. Because if it's easy to buy, it's easy to sell, right? The stock market allows you to sell your stock at any time you want, right? Economists are going to use the term liquid, right, to mean that you can turn your shares into cash quickly with low transaction costs, right? Now, that's important if you suddenly need your money, right? Especially since prices can be very volatile, right? And then you run the risk of being forced to take a loss. Okay, as with anything, if there's benefits, there's disadvantages. Let's talk about those, right? And the first one is we're going to talk about how risky it can be. You could lose all your money, right? If a company does bad, investors are going to sell, and the stock price is going to plummet. And then when you sell, you're going to lose all your initial investment. And if you can't afford to do that, you might want to invest in something else, right? The one of the safest things that you can invest in is a bond. Now, I don't recommend investing in bonds, but that's one of the safest things you can invest in, right? You also get an income tax break if you lose money on your stock loss, right? Now, you also have to pay capital gains if you make money. So the next thing we're going to talk about is stockholders are paid last. You've got preferred stockholders and bondholders or creditors, right? And they get paid first if a company goes broke, right? If a company goes bankrupt. Well, a well-diversified portfolio should keep you safe if any company actually does go under. The third one is one of the bigger ones, right? It's time. If you're buying stocks on your own, you've got to research the company to determine how well you think they're going to do before you buy it. You've got to learn how to read all these financial statements and annual reports and earnings reports and then follow the company's developments in the news, right? You've got to monitor the stock market itself, right? Even the best company's price is going to fall in a market correction, a crash, or a bear market, right? Which leads us to the next one, an emotional roller coaster, because the stock prices are going up and down all the time. You might look one day it's up 10%, look the next day it's down 40%. You never know what's going to happen. And individuals tend to buy high out of greed and sell low out of fear, which we don't want to do that, right? The best thing to do is to not constantly look at the prices of stocks and just check in occasionally, right? Now, the last one is going to be professional competition, right? Institutional investors and professional traders, I mean, they have more time and they have a lot more knowledge, right? For them to invest in different stocks and companies and everything that's going on, right? Now, they also have these crazy sophisticated trading tools. They have all these financial models and these computer systems, that just they have all these extra things at their disposal, right? So there's a couple ways that we can address some of these disadvantages, right? And of course, that's with diversification, right? We can diversify to lower our risk, right? And there are ways to reduce your investment risk, right? And when we diversify, there's a couple different ways we're talking about doing that, right? So one is by investment type. A well diversified portfolio will provide most of the benefits and fewer disadvantages than stock ownership alone. Right now, this is going to mean a mix of stocks, bonds, and commodities. Over time, it's the best way to gain the highest return at the lowest risk. The next one's going to be by company size, because there's going to be large cap, mid cap, and small cap companies, right? Cap is going to stand for capitalization, right? And that's going to be the total stock price times the number of shares. Now, it's good to own different size companies because they perform differently in each phase of the business cycle, right? The third one is going to be by location. You can own companies located in the US, you can own companies in Europe and Japan, emerging markets. Diversification allows you to take advantage of growth without being vulnerable to any single stock. Right? And the last one, the fourth one, it's going to be through mutual funds, right? This is what most people need to start out with, right? Owning mutual funds, right? Because it allows you to own hundreds of stocks that are pre-selected by a mutual fund manager, right? And it's one of the easiest ways to diversify, right? Buy an index fund or an index ETF, right? These are the best way to get started when you first start investing, right? So what do we learn from this? What's the bottom line? Well, I mean, you should establish your asset allocation based on your financial goals and where the economy is in the business cycle, right? So you're going to want to address your risk tolerance and how you want to invest. What do you want to invest in? Do you want to do the research into individual stocks and pick your own stocks, or are you just going to buy a mutual fund or an index fund and go from there, right? You really should do some research and look into how much time you want to put into it, right? And then go from there. Okay. So I really hope you guys enjoyed this video. If you're not subscribed to the channel, I'd really appreciate it if you did. If you liked the video, go ahead and hit that thumbs up button. Until I see you guys in the next video, y'all be safe.